Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump says his July 9th global tariff deadline won't be extended. This as he ramps up criticism of Tokyo and says he's doubtful a trade deal will be reached with Japan. President Trump's multi-trillion-dollar tax bill narrowly passes the Senate, but now faces resistance in the House. Plus, Starmer weakened. The UK Prime Minister's welfare legislation passes Parliament, but only after its main provisions are dropped, leaving a potential £5 billion hole in the government's finances.
Lots to digest there on both sides of the Atlantic. Let's kick it off with what the markets are doing, which is marginal positivity here, higher by 0.4% on Eurostoxx 50 futures. Also, FTSE 100 higher by 0.2%. But take a look at that 10-year yield as we talk about trade negotiations, as the deficit story looms as well. 4.24 on that note, 117, almost 118 on Eurodollar, 137 handle on the pound. Lots of green on the screen. We're going to dive into the details. The countdown to the opening trade starts right now.
No, I'm not. I'm not thinking about the pause. I'll be writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make it. I doubt it with Japan. They're very talented.
The President of the United States speaking on Air Force One, looking to maybe make an example of Japan. The question is, as a market participant, what do you do with that? Do you ignore it? Like, he changes his mind fairly often. The problem with that changing his mind sort of theory is that we are approaching the deadline that is coming towards us quite rapidly, the 8th and the 9th. It's next week. So do we now need to start taking it more seriously and maybe price in some more difficult scenarios? Well, we're not doing that quite yet. There's some jitters overnight in Asia, but not big ones, Chrissy.
Not big ones, to the point that the markets aren't even blinking an eye here. I'm looking at dollar yen, for example. We're still at a 143 handle. The story very much on monetary policy on that side of the world. But I think this is interesting because it speaks to this idea that the potential calm in the markets driven by the idea of extensions is not actually on the table at all. And we're still looming towards it. We are 5 days away from the July 9th tariff deadline, which is interesting because it's making a complete 180 on the Japanese trade deal after, by the way, green-lighting the Nippon Steel deal, which was really seen as a gesture of good faith towards Japan, only to hit road bumps.
I mean, President Trump says he still really likes the Prime Minister of Japan, but still not sure he's going to get a deal done. I mean, you could tell a more alarmist story about this. You could suggest that you could look at what's happening to the Nikkei and it's down 0.5%, and there is some evidence that Trump's tariff rhetoric is still having an impact on markets. So there is that. And even US stocks dropped at the time that he mentioned this, didn't they? So it is clear that still this has the power to move markets. It's just that, to your point, maybe we're not at the end game, so you don't know what to do with it just now.
You remember the drop that we saw when the tariff, this whole sort of story kicked off? We're standing there, we've got a big kind of board, we're talking about numbers that don't make any sense. Markets drop dramatically on that. This doesn't feel like we're seeing that at the moment.
No.
And we are approaching a deadline that could reimpose some of those same sort of numbers.
You've had really interesting conversations around this desk in recent days about the extent to which this is not priced in by markets. Some of the numbers are not priced in. So I think yesterday we were talking to Morgan Stanley saying, you know, if this goes to 20%, it's not priced in. Later on, we're going to be talking to a JP Morgan guest who's going to say, who I know thinks that high single-digit, low teens is what the market is pricing in. So it seems that we're still in a sort of price discovery mode and maybe, sitting on our hands until we work out which
What's
way
interesting
this
is that we're broadening out into small caps. The market's rotating into what looks like a cyclical trade, which is amazing. We'll talk to Val about that a little bit later on. So let's talk about the big, beautiful bill and where we are. Because, again, this is amazing stuff that doesn't seem to be kind of touching the sides in terms of where the market is right now. So the Vice President has to break the tie in the Senate yesterday, which is amazing to start with. But that's where we are. So it comes out of the Senate. It's more expensive. It's significantly more expensive coming out of the Senate, but it's passed. So now it has to go back to the House before the 4th of July, which is Friday. So the timeline here is quite truncated. So Mike Johnson, Speaker of the House, has got 3 votes to play with. He's actually, in reality, I think, probably got less than that. And the first thing that's going to happen later today is it's going to go to the Rules Committee. There's a bunch of hawks on the Rules Committee. It may not even make it out of the Rules Committee. It may not even make it back to the House, and it may end up having to go back to the Senate, or we end up with some sort of situation where the House and the Senate have to come together in some sort of conference committee to try and thrash out their differences, which looks difficult at this point.
Yeah.
So this is not a done deal by any stretch of the imagination.
Yeah.
In fact, it could get harder from here because this thing is more expensive.
And it's been hard all the way through. Only just past the House, only just past the Senate. Now back to the House, and will it pass again then, Critty? Seems to be the key thing. And Guy, you mentioned the hawks, but there's also the objections on the other side of the GOP, those who are concerned about the cuts to Medicaid. So, you know, there are still both of those arguments going on.
Yeah, it's interesting. They had to the point that they've started to kind of put in pieces of rural hospitals as one example to address some of those cuts as well. But here's what it does as well, and you've, of course, outlined the bear case. Let me give you the bull case of this deal. Although it does talk about a deficit of, or an increased cost of $7 trillion instead of the initially anticipated $3 trillion. So you are seeing a massive bump in terms of that. But if you're looking at the extension of tax cuts, which was a worry here because the tax cuts were expiring and have been in play from 2017, that also would have hit the bottom line and the spending that a lot of U.S. consumers have continued to prove that they're willing to do. So that extension is actually a positive. It's also talking about lots of money allocated towards defense and immigration at a time when he was talking about pulling some of the federal contracts from the defense spending place as well. So there are places where this fiscal spend, although not so great for the balancing the books of the United States, is actually helpful in terms of actually fiscal stimulus when it comes to various sectors of the economy.
This is peacetime in theory, right? So we're running massive 5, 6, 7% deficits in peacetime. And that's okay.
And the markets didn't seem to mind. The markets moved more on 1 month's worth of JOLTS data about, you know, job openings. The markets were moving on that. That seems to be the market focus, doesn't it?
And they ignored Powell, which I thought was fascinating.
Yeah.
Powell sounded like he was like, July could be on here. Yeah. So, and the market went, no, I don't think so. You've seen the data. Yeah,
so the things that are and are not moving markets seem to be a theme, and one we'll return to during this programme. Let's talk about, talking about allocation of money, let's talk about the UK and the vote around the welfare bill yesterday.
A very similar conversation on this side.
We will be watching the gilt market, certainly. That opens up in around 54 minutes' time. We'll certainly be watching to see. We didn't see a huge amount of movement in the pound, but gilts could be where the interest is this morning. Of course, this opens up huge questions around fiscal credibility, around where how the hole is filled. What kind of tax rises might we be talking about later on this year? Do we start to talk about, I mean, how did we end up in such a procedural mess in the first place where concessions had to be made so late in the day? And will we see resignations? Will we see changes to the top team as a result?
Those are rhetorical questions. Anyway.
Yes.
Rachel Reeves looks like she's going to have to push taxes up. Can she stay, considering that was such a big manifesto pledge, can they do that without getting rid of her? I think that's a question that is now being widely debated. Starmer's 1 year into his term now. If year 2 doesn't look better, you've got to question his credibility as well going forward from here within the Labour Party. But the hole is big.
Yes.
Our income tax is going to have to go up, and I think that's a really tough thing for them to have to do, but it looks increasingly likely one of the big levers of taxation are going to have to be pulled here.
They managed to get the increase in employees' national insurance through, didn't they, by trying to make that stack up with the manifesto pledges, but harder to get some of the other taxes to increase and stick to that manifesto pledge. That's certainly the case. And we've already had Prime Minister Starmer concede that he was really hugely distracted, Critty, by international events over the last 12 months. And so perhaps he'll have to focus more on the domestic agenda in the second half of the year. At least his trade deal, he's pretty much the only one that has been done. Even if I say done, I mean, it's done, ... isn't it? You know, see steel, see other things not quite done.
Well, the market reaction is still really fascinating. 137 here, a handle there on the pound, regardless. Almost 138 if you're going in terms of the direction. But it's fascinating that you're having the exact same issues in the U.S. as the UK in terms of the actual passing of the bill. But the difference is, in the UK, we're talking about tax hikes. In the U.S., we're talking about tax cuts. Both still dealing with deficits, both still dealing with a lack of market tantrum. So we'll see if that changes today. The
numbers don't stack up on either side of the Atlantic. Do you want to invest in the UK, considering all of this? Well, one of our next guests does. Jose Garcia-Cantera is the CFO of Santander. Santander is going to be buying TSB of Sabadell. Why, I think, is the question that we are going to be asking ourselves as we have that interview coming a little bit later on. Does it really stack up? Eric Witteness, JP Morgan Private Bank EMEA Investment Head of Strategy, is going to be joining us. And Mario Centeno, the Bank of Portugal Governor, is going to be joining Francine Lacroix in Sintra a little bit later on. Very windy there, I understand, today. So maybe there's some sort of weather-related stuff going. I think we should talk more about the weather, but maybe we'll save that for Friday.
I'm here for the aircon.
It's getting cooler. We're all here for the aircon this morning.
We all have lots of thoughts on the heat. Let's talk about what else we've got on the daybook today. Lots going on the agenda. Of course, we are counting down about less than an hour's time to the gilt open. At about 10 a.m. UK time, we also have a 30-year gilt auction as well. We'll see if there is a bit of a read-through from the events, basically, of the last 24 hours here in the UK as well. Do you have a German bond auction? Are people still buying debt? Are they buying the long end? We're going to find out, at least in terms of Europe. And then in terms of the data, U.S. ADP numbers, a little bit of a precursor to some jobs numbers we may get down the pike.
We are going to get them tomorrow. Quite exciting. We're going to wait and see what happens. Thursday is coming. Today's Wednesday? Today's Wednesday. OK, what else do you need to know this Wednesday morning? President Donald Trump says Israel has agreed to conditions for a 60-day ceasefire in Gaza, which will now be presented to Hamas. Trump added that he hopes Hamas will take the deal, warning it that the deal will not get better, only worse. The Israeli Prime Minister Benjamin Netanyahu is set to visit the White House Monday. The US has stopped deliveries of artillery rounds and air defences to Ukraine after a review of munitions stockpiles. The White House says it follows concerns that the US weapons stocks have now fallen too low. The decision comes as Ukraine struggles to repel record missile and drone strikes by Russia, which have intensified in recent weeks. And the French President Emmanuel Macron and Russian leader Vladimir Putin have agreed to coordinate their approach on Iran in their first phone call since 2022. Sources have told Bloomberg the call is part of an effort to align strategy on Iran by the 5 permanent members of the UN Security Council. During the call, Macron also pushed for a Ukraine ceasefire, but Putin rejected it, insisting any deal must address the conflict's, quote, root causes. OK?
It's interesting, isn't it? That, I mean, Macron was one of the last to stop talking to
Yes.
Putin, wasn't he, on the way into the Ukraine war? And now he seems to be one of the European leaders who is OK to talk to him. It's not about Ukraine, it's about Iran. And they seem to have some common ground to come to as a UN Security Council. But they're going to try to. But I think that is interesting that we have a European leader here opening the door, at least on that particular topic, even if they're trying to segment Ukraine and keep that separate.
Absolutely. It's going to be a fascinating one in terms of the geopolitics. But I'm curious at what point they're actually setting the precedent for other European leaders. Will Keir Starmer get on the phone to Putin? Will Friedrich Merz get on the phone to Putin? That I don't know.
We'll wait and see. Coming up on this programme, we'll take a closer look at the stocks to watch at the open, including then Santander. That's after the Spanish lender agreed to buy Sabadel's UK unit TSB for £2.7 billion. We will get into a conversation about what is attracting this particular, Santander to buy this UK asset from another Spanish bank. Plus, analysts expect Tesla to deliver another downbeat quarterly sales report later today. It comes as CEO Elon Musk takes over responsibility for sales in Europe and the United States. We'll discuss the implications of that move. But up next, we'll be joined by Elsa Linos, Global Head of FX Strategy at RBC Capital Markets. Is there strength, is there benefit in a stronger Europe for parts of the European economy? A lot of the conversation at Sintra seems to be about whether this might lead to downside risk on inflation. We will talk about that shortly. If you have any questions for our guest, then please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
A couple of things to point out, one of which, no tie. We can talk about that maybe. It's hot in Portugal, though, I think. A little windier today. So that's the weather forecast and the tie story. Let's talk about how the market reacted to what Powell had to say yesterday. They basically ignored him, which I think is interesting. Traders ignored him. They focused instead on the data. The conversation with all of the central bankers in France yesterday was fascinating, though. What we saw yesterday in US markets, I don't know. What can we read into it? Valerie's here to try and answer that question.
Well, look, the S&P 500 pulled back from record highs, but there was some interesting rotation going on under the hood. We saw the small caps outperform tech stocks, and actually the biggest margin going back to April. So it's not something we see often, Guy. Many narratives out there trying to piece together why this was. Some saying that Senate bill getting passed, there's a lot of government spending involved in that could help boost those domestically oriented small cap stocks. On the tech side, there was a big retracement when it came to momentum stocks, maybe people taking chips off the table of their winners before non-farm payrolls yesterday. There also was Tesla sinking 5%, which did drag down the Mag 7. But this rotation was notable. The equity market also had a hard time rallying in the face of these two-year yields rising. We did hit the lowest in 2 months, but it was that hot JOLTS data, job openings data exceeded expectations, and then ISM and manufacturing came in slightly better than expected. So it was really what the bond market was looking at. The data, rather than anything Powell said yesterday, led to front-end yields rising around 6 basis points in the last two sessions. Ideally, something like this, short-term interest rates rising, would be something that would support the dollar. It did not. We continued to see the U.S. dollar on the back foot, and that meant that the euro dollar has clinched 9 straight sessions of gains, Guy, the longest winning streak in 20 years.
It's amazing, isn't it? And you would have thought, logically, actually, a weaker dollar would help U.S. tech. Big translated earnings story back into the US. That should be helping the bottom line, and that might show up in the next earnings report as well. Valerie, perfect setup. Thank you very much indeed. Valerie Taitella, what's happening in these markets? Which brings us on to a conversation with Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Good morning.
Good morning.
If we get a strong payroll number tomorrow, do I buy or sell the dollar?
So strong payroll number is actually not going to change all that much in terms of the very short-term outlook for the Fed. I think if you start to see cracks in the US economy... That was my next question. What was a bad number? Exactly. So if you start to see genuine cracks in the US economy, I think it feeds into the momentum around the Fed is going to have to cut sooner than expected, and, we're on the way towards a real reduction in carry costs, which I think will prompt a further wave of hedges being put on US assets. Strong number, I think, is a little bit more status quo. I mean, there's maybe room for a bit of a pullback, as you were highlighting just there. We've had a very strong run for euro-dollar, or dollar generally lower for the last 10 days. So maybe some room for consolidation on a strong...
Big picture, where are we going with the dollar?
So big picture, we've had this target of 124 for a while, which was a 2026 target. I still think it's something that will take some time to get there, because you do need to see that cost of hedging actually falling for the hedges to materialize. I think what's really interesting, I was discussing this with our forwards traders yesterday, you're not actually seeing basis move that much to the negative side, which you'd expect if this was all about hedging flow. So a lot of it, I think, is anticipating the flow that is to come rather than the flow itself.
Explain that a little more to me, Elsa. What are we looking for?
So effectively what we're seeing at the moment is investors are anticipating the weakness of the dollar. It's really interesting. I spent last week on the East Coast seeing clients all across New York, Boston, Toronto, Montreal, and everybody is bearish on the dollar. And yet they also feel underpositioned because sometimes the speed of the move has been so fast, they've not gotten as short dollars as they would like.
OK. And so does that mean that where does that leave the euro over the summer? Because a lot of so going from the dollar side of things to the euro side, a lot of the conversation in Sintra has been around whether the strength of the euro, yes, that maybe has been a good thing and allowed inflation to come down a bit, and now entirely on target, it would seem. But then does that start to spill over into something that might weaken inflation too much? How are you viewing the euro?
Yeah, it's interesting because we have started hearing more comments from ECB officials from Sintra over the last few days. And I think the other thing that will certainly be on their radar is it's not just euro-dollar. If you look at euro-renminbi, we've had a pretty big move. The fact is that the renminbi has actually been depreciating against all other currencies by effectively more or less keeping pace with the US dollar. I think that's going to be far more of a problem in terms of European exports, imports, than euro-dollar itself.
You made a comment about the speed of the move in terms of euro-dollar specifically, but in terms of the fact that clients are feeling underpositioned in terms of being short dollar. 6 months ago, we were having a conversation about parity if a trade deal doesn't come through between the U.S. and Europe. Is there a concern here that you can swing back in the other direction in terms of euro-dollar's move to the upside? Can you weaken and reverse that very quickly?
So I think part of what we're seeing at the moment is a genuine shift in terms of hedging behavior. We last saw it in 2020-21. If you remember, it's the last time euro-dollar sustainably reliably traded above 120, and it was when the Fed cut rates effectively European, rest of world type levels. Again, you saw a big wave of hedges being put on. That's what we're seeing this time too, unless you really think the Fed is not going to be cutting rates at all through 2026, and I don't think anybody or very few people have that forecast. Eurodollar is on a path higher. The flip side, though, is that there is scope, I think, this time round, if we do get a re-escalation in tariff concerns, next week into those July 9th deadlines. And if it's not broad-based, if it's not Trump doing this to all countries, but if it's more bilateral, I do think those pairs might come under a bit of pressure. It's not a consensus view by any means, but I don't think it's a kind of a done deal that the dollar is straight lower from here.
What about the pound? How does that fall into all of this? Because for the euro, I feel like you can make a decent case of why there are fundamentals to support the strength in the European currency. But what about the pound?
I mean, what's really interesting about this move is it's really more a dollar move than anything else. So, you're seeing cable higher, euro dollar higher, dollar yen lower, Aussie dollar higher, dollar CAD lower. And the pound kind of falls middle of the range in that. You've had relatively high rates compared to the rest of G10. The Bank of England now appears to be catching up. We think there's good scope for them to be doing more into the end of this year. And so it does undermine the pound a little bit. Euro sterling has actually had a fairly decent move higher in the last few days.
Is the risk to your 124 euro dollar target to the upside or the downside?
That's a great question. When you see the speed of the move you have over the last 10 days, it almost feels nerve-wracking to say only 124. Why not 130? Why not 135?
Well, I think we've heard 150 as our top target on this show. That's quite punchy.
That's extreme. But at the same time, the closer you get up to those levels, valuation is a very nebulous concept in FX. But when you get to those kind of mid-120 levels, it becomes a lot harder to justify why you'd want to be massively long euro-dollar from there. When I speak to investors, and yesterday was not a great example, but in general, they say if you want exposure to tech, to AI, to good productivity growth, you still have to have exposure to the US. It's not like you're going to put all your money back into Europe. And so underlying it, there's going to be a bid for dollar somewhere along the way. It's just probably not just yet.
Yeah, you mentioned the yuan, and obviously that's a sort of managed currency. We're watching headlines cross our screens in the early hours around the Hong Kong dollar and whether the peg will be maintained there. Are you concerned about any of either pegs or managed regimes elsewhere where things might break? Are we talking, because the dollar move has been quite fast, would you say, first half?
Yeah, I mean, it's certainly been a very bad start to the year for the dollar, one of the worst ever, although coming on the back of a pretty decent rally into year-end post-election. And then on top of that, if you think about it, the dollar is coming from very elevated levels. It's not like we're stretched from a big picture valuation perspective. Effectively, the dollar has been very rich for a long time. US exceptionalism was the dominant narrative, and now we're seeing that kind of reprice.
Very quickly, Elsa, should we be trading FX on trade headlines, or is the monetary policy still in the driver's seat?
It's a great question, because actually one of the things that was really striking about my conversations last week is how low on the agenda tariffs and general trade concerns were for investors. At the same time, though, I can't help feeling that as we get to next week, if Trump does follow through with some of the more recent threats, and that's not the market expectation, right? I think everybody's come around to this idea that he always backs down. But if he does follow through, particularly, like I said, on certain individual countries, I do think that's going to have an impact on currency markets.
All right. Elsa Lignos, Global Head of FX Strategy over at RBC Capital Markets, walking us through her calls on the euro and the pound as well, among several others. We thank you so much. Coming up on the program, Santander agreeing to buy UK bank TSB from Sabadell in a deal worth £2.7 billion. We're going to get into the merits of the deal and perhaps the concerns around it with Santander's CFO on the program next. In the meantime, futures still pointing higher. We are about 30 minutes away from the opening trade. Stick with us. This is Bloomberg.
Welcome back to the programme. 30 minutes until the start of trading for this Wednesday, the 2nd of July. Let us show you the futures picture for Europe then. We are expecting to go a little higher, despite the fact that we heard from President Trump about his thoughts, not minded to give any extensions around the July 9th deadline when it comes to tariffs. That doesn't seem to be worrying markets overly too much. It worried the Japanese market a little bit, but here in Europe, we've seen resilience to that. And US futures also up by around 0.3% this hour. Quick look at the bond markets as well there. We're watching again, there wasn't too much read across from the US fiscal story. That bill goes, of course, back to the House, so we continue to watch the twists and turns of US politics. On to what's happening in the banking sector here in Europe. Banco Santander has agreed to buy UK lender TSB from its Spanish rival Sabadell. The deal, worth £2.65 billion for now, will make Santander the UK's third largest lender by some measures. We're joined now by the Santander CFO, Jose Garcia-Cantera. A real pleasure, Jose, to have you on the programme. Thank you very much for being with us. So this deal can be seen as quite an expression of confidence in the UK, in the UK economy. A lot of businesses recently have been speaking out against recent tax rises on employing staff and various other measures. How optimistic are you feeling about the UK then as a result of this deal?
Good morning, and thank you for having me on the program again. We already have a very significant presence in the UK. It's our largest balance sheet in all the countries where we operate. We operate the largest balance sheet in the UK. We mostly do mortgages, and this transaction will help us accelerate our transformation program and serve our customers better. Obviously, you know, we like the UK, we like the regulatory regime in the UK. We think is the second largest financial market in the world, and we want to have a significant presence in this market.
What happens to the TSB brand, or how quickly do you remove it, Jose? Your business, of course, has a lot of history around Abbey, Bradford and Bingley, other businesses going back years, taking those over and rebranding them as Santander. Is that going to be the same path that we take here?
We do this, again, for the customers. I mean, we believe TSB customers now will have access to more branches, to better technology, and we think this is going to be a better value proposition for them. The transaction is going to take a few months, probably into the first quarter of next year, to be finally approved. It needs to go through different levels of regulatory approval. So it's going to take a while before we actually take control of the asset, and then, you know, we will decide what to do. But the TSB brand is a very important brand. It has a lot of value. It's been in the market for over 200 years, and we believe it's a brand with a lot of value. But again, it will take time before we actually take control of the bank.
Well, Jose, it's Creedy in London. Talk to us a little bit about when I appreciate that you have little visibility at the moment until the deal actually closes, but there's a question here around the math of TSB, and one that perhaps the value that this deal is closing at is perhaps too expensive, and the only way that it works is if there are massive job cuts to maintain some of the costs. Is that something Santander is considering in terms of moving forward with TSB?
I think the main reason why the numbers work is because, yes, we can operate the combined entities with a lower cost base, but most of these savings will come from projects that TSB is currently running that we will not need to do when the two banks merge, investments in digital means and channels, etc., that we are doing at Santander. So yes, there will be savings. Yes, within these savings will help us offer better products at lower cost to the customers, but not all of these costs will come from job cuts or branch closures. Clearly, customers are now have opted to bank in a different way in the last few years. They're using more digital channels to relate to the banks. And that is a reality that we obviously need to adjust to.
Well, Jose, can you just give us a little bit of background, international audience, a little bit of background on how this deal actually came about? You know, there are plenty of reports that Barclays was in the running as well to take over TSB. There's also been lots of speculation that Sabadell has been trying to offload TSB as it fights kind of a takeover battle in terms of BBVA at the moment. Where did Santander start in terms of getting interest in TSB?
Well, we looked at TSB 10 years ago when when Lloyd's decided to spit it out, and we actually had interest in acquiring the asset, but the process was very, very long. It was a very lengthy process, so we dropped. This is an asset that we like, that we know, and when Sabadell decided to run a process. Because this obviously fits with our capital hierarchy in terms of bolt-on acquisitions. And as we have said in the past, the UK is really important for us because it's a stable market. We have a low-risk business. TSB has a very, very similar business to what we have. It's very complementary, and financially, it works very, very well. So that's when we decided to look at TSB again.
Good morning, it's Guy. Why is the UK the right place for you to put your money to work in? My understanding is that this is one of your lowest profitability jurisdictions. Why aren't you putting money to work in Latin America or other areas around the world that are going to generate a higher rate of return for your investors?
The UK is really important because it helps stabilize our cost of capital, our risk-return profile. We have a low-risk business in the UK, is a stable returns in a strong currency. So this helps stabilize the volatility of our returns that come in developing economies. We have a plan. Prior to the acquisition of TSB, we had a plan to increase our profitability in the UK from currently 11% to by around 1 percentage point per year in the next 3 years. This acquisition will help us accelerate this improvement in profitability, and we think we can reach 16% return on equity in the UK in sterling in the next 3 years. A transaction that has a return on capital invested of around 20% or higher, and it will be accretive from year one. So we think financially, not only strategically makes sense, but also financially is a very strong transaction.
I think it's really interesting you're talking about the fact that it's in sterling, the fact that the currency matters in all of this. Did I hear you correctly just a moment ago when you said you're getting access to better technology from TSB? Yes. That doesn't seem to be the experience of a lot of people. All right.
Okay, what I mean is that for TSB customers, we are doing this because we think we are a better holder of the asset. We can now offer our technology to TSB customers. They will have access to our bigger network. So they will have more physical distribution network, better technology, better digital. That's what I meant.
Are you going to get rid of the TSB technology base? Because it's historically kind of been challenging.
We are going to migrate to our own technology, yes.
Okay.
Can I ask you about the US, your US expectations, Jose? That's an important part of your business as well in the United States. And I wonder if you're minded to increase exposure. I know that's been a plan for a while. If that's still the case, is that affected in any way by your plans elsewhere?
No, in the UK, we have our own business as usual strategy. We launched our native digital bank, Open Bank, in October. We already have over $5 billion in deposits from over 100,000 customers. We are integrating the different units that we have in the US. So we are not looking at doing M&A in the US at the moment. We are rather looking at developing our own strategy with the aim at gradually integrating the different businesses that we have in the US.
Well, Jose, sticking with the theme of M&A, let's circle right back to Spain here. There's been a question in the last week or so, especially after the concerns around banking regulation, banking consolidation between BBVA and Sabadell, of whether or not Spain and the Spanish government is actually amenable to banking consolidation and M&A within Spain itself. Your thoughts?
No, I think this is for Salvador shareholders to decide. So at the end, it's these are two private companies. This is normal course of business in the life of companies, and it's for the shareholders, or the shareholders will be free to decide what to do in this case.
Final quick question. Do you think this transaction is going to make it harder for BBVA to take over Sabadell? And if so, was that part of your calculation in making this acquisition?
No, that's not what we think about, and obviously we are neutral in that sense. Again, this is an asset that is available in one of our core markets. We have the fiduciary duty for our shareholders to look at any bolt-on acquisition in the markets what we operate. This transaction will make our presence in the UK better. We will be better positioned to serve our customers and TSB customers better, and we will be able to make greater returns in the UK. So if this has any impact, obviously, in that sense, we are completely neutral.
Santander CFO Jose Garcia-Cantera joining us this morning to talk about Santander's latest acquisition, TSB. Of course, the deal expected to close in early 2026. We thank you so much. It's fascinating what he's saying, though, really doubling down on his exposure to the UK specifically at a time when a lot of people are saying, actually, maybe Santander's looking elsewhere. And he's saying, actually, we can consolidate, we can offer better technology. And this works, ultimately, in his words, to the customer's favor.
It's in sterling.
Yeah.
So he kept pointing out it's in sterling. Is the currency part of this transaction, therefore, there is an expectation that sterling is going to be a solid currency, potentially?
Yeah, he said
an improving
in a strong currency, didn't he?
Yeah.
Yes, it was part of a conversation or a wider answer around stabilising risk, getting and stabilising returns. So yes, it's part of that wider narrative, but pretty positive on the UK right now.
The technology integration is going to be interesting.
Yeah,
it is. There's been some history there, hasn't there?
Oh, yes.
TSB. Right, we will continue to monitor that one. We'll watch how the Spanish banking names trade at the start of trade this morning. Coming up next, then, some relief for the renewables industry as a tax threatening solar and wind is stripped out of the US mega bill passed last night. Your stocks to watch next. This is Bloomberg.
We are determined to continue to be data dependent, to decide meeting by meeting, and to not commit to any particular rate path.
We are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve. But as I mentioned, a majority of us do feel that it will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
It will depend on the relative strength of the 3 inflation dynamics, and we need some more information to determine that.
We are going to have to see those come through, though. I mean, come through into prices. I think we've still got to see the evidence and prices. But that background context allows certainly me to say, look, I think the direction of interest rates continues to be downwards.
We cut our interest rate 100 BP from last October, and we will continue to be in an easing cycle given our growth rate. But recently, financial stability risk has been rising. So we are keeping an eye on this financial stability risk in deciding the pace and the timing of the further cuts.
Some of the world's top central bankers speaking to Bloomberg's Francine Lacroix in Portugal at the ECB's forum in Sintra, wrestling with a host of uncertainty topics there, Critty, and US debt levels and debt issuance, another topic of uncertainty that I know has caught your eye.
It has this morning, Anna. I mean, it has, I think, to everybody, because we know there's an X date looming. We don't really know when it is. Latest JP Morgan analysis, for example, saying it could happen in late August, early September. It's getting pushed back further and further, but I think this is the chart that I really want everyone to pay attention to. You kind of have to zoom in a little bit, so maybe the cameraman can follow me closely. This white line is the debt ceiling actual from the congressional limit. This blue kind of dotted piece that very closely tracks this line is the actual public spending. Now, the reason I bring these two together is because there is a question, and there has has been around at the moment about when those iterations are, when the spending ability actually goes above the debt ceiling. And the reason here is that that debt ceiling is a congressional limit. It doesn't actually have to do directly with government spending. It has to do with how much the Treasury can actually borrow. And that's where the key piece of this is, because you can see in recent years that kind of increase over that white line has come up more and more. And it's largely because of those interest payments, Anna. And that's where I want to bring you my next chart here, which is this idea that the majority of that public debt, of the deficit story, is actually in interest payments. 13% of those U.S. budget costs are now only for debt servicing. And Anna, this is the key piece of the conversation here, is as we get closer and closer to the X date, whenever that X date may be, a.k.a. when the U.S. government does ultimately run out of money, there is a question here of whether or not the bond market is actually going to react. And I can tell you right now, the bond market is not paying attention to this chart. Will it in late summer?
Let's think about that some more then, Chrissy, and go to our Markets Live executive editor, Mark Cudmore, who is with us this morning from Dublin, I understand. Good morning to you, Mark. Let me ask you about what the market is thinking about the budget process in the United States now, because for a long time we've talked about this, and some are concerned about what this does to Medicare, some are concerned about what this does to debt levels in the United States, importantly from a market perspective. But is that really what is driving market thinking right now? What are you watching as this goes once again to the House?
I think that the interpretation from markets at the moment is probably missing some of the subtlety and nuance, and just going, this bill, if it is passed and is currently presented, is a massive net injection of money into the economy. And in the classic equation for GDP, that makes it impossible that we have a particularly harsh growth slowdown, and should boost growth. And that is therefore clearly positive for stocks. Now, there's going to be concerns about what happens on the debt side, but we're not currently playing that dynamic. Obviously, there's still a risk that the bill doesn't pass, and I do think that this is a market that is trading kind of assuming it'll ultimately be passed, and that is probably the right base case. But I think the probability of failure, or at least an extended delay beyond the holiday, is maybe larger than is priced in the market at the moment. And we're certainly seeing a stock market that is trading very positively. The dynamic yesterday was, even though the stocks fell in the US, small caps rallied, and that's a broadening out of the rally. It's going to pro-cyclical names. It's going to this idea that we have to get on board the optimistic, bullish story right across the board.
Mark, good morning. It's Guy. So we've been through 118 euro dollar a couple of times, 3 times, I think, over the last 24 hours. What stops this trade? What delivers a dollar bounce? Are we getting to the point where we're a little bit oversold on the dollar? Is there anything that changes the trend that we're watching at the moment? And if not, how far can it go?
So, 2 different time spans. Longer term, nothing is going to change this trend for a couple of years. Dollar's got a long way further to fall. 10, 15% further, whatever. You know, we've talked since the start of the year about euro dollar going to 130 before 106 from a few months ago. So that's probably just an easy conservative target. Could go to 140, could go much higher. Dollar is a long way to fall. Now, what is going to cause a bounce in a short-term bounce? At some point, there'll probably be a position squeeze. Now, positioning has changed very rapidly from short-term players. They've gone from being really long the last few years to being net a little bit short, but they're not extreme short yet. Now, the pace of change of positions means that there's probably a lot of people who have got into the trade late, so there's some fragile hands there. If we have a catalyst for a squeeze, it could go a little bit more painfully. But any of those positioning squeezes will only be short-term, and ultimately, the dollar is in a long-term depreciation trend.
Mark, is there a line in the sand of when we might expect that positioning squeeze?
No, I think it's going to be. I probably didn't fully answer Guy's question, and which you're pushing on pretty correctly, is what's the catalyst? I think it's probably a risk-off event. So it could be something as soon as the tax bill failing, or it could be something like one of the trade deadline next week. We've got a lot of obvious catalysts on the horizon. We've got the macro data tomorrow. We've got a week full of catalysts. I think if there's a catalyst that causes a big risk-off, that will just cause people to deleverage. It'll squeeze out some of those short positions, and that might get a bit of momentum that can run for a couple of percent. But that's all it will be.
All right, Bloomberg's Markets Live executive editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Chrissy. So we're watching renewable energy stocks once again in Europe today after another tweak to the big, beautiful bill in the US. Now, the latest version from the Senate strips out a tax that was going to put a levy on components that are made from China and used in projects in the US, so renewable energy projects, getting that relief, the ones that are using Chinese components. Now, this is a big relief for Vestas, according to a JP Morgan analyst, which has a note out today, and potentially we are going to see that feeding through into the market this morning, into those share prices. So keep an eye on Vestas, as well as Ørsted, also listed in Copenhagen, and Nordex and SMA Solar in the solar space as well. So wind and solar potentially going to benefit from this latest version of the bill. Then we're looking at Spanish banks following this deal between Santander and TSB, as you guys were discussing earlier on the show with the Santander CFO. Now, this means that Santander will take on around 218 more branches in the UK, serving more than 25 million people in the country. We can see Sabadell stock has actually outperformed, given we've had that big interest from BBVA in terms of a full takeover. So potentially we might see it getting another boost today. But for Santander, this quote from Citigroup did catch my eye, saying that it is surprising that Santander chose to use the money they made from selling a bit of their stake in a Polish bank to buy a unit of Sabadell, TSB, which is underperforming. So they actually think it's surprising that they're using cash to buy a business that isn't actually performing very well. So we'll wait to see if Santander shares react negatively to that one. Finally, we've got Airbus, slightly missing on its latest orders, getting around 60 plane orders, and it does look on track to actually miss its full-year target, though potentially there is more to come later in the year. We'll see if it trims some of its outperformance versus Boeing, but bear in mind, analysts really positive on this one still. We'll wait to see if Airbus reacts to these later today.
Joe, thank you very much. Our equities reporter, Joe Easton. So we watch, I mean, those wind and solar names, they've been on a really blustery ride, if that's the appropriate...
That's wind. You can't use blustery.
Well, that was wind and solar.
So wind and solar, sorry. I just heard solar.
So I couldn't think of a solar one, so I just wrote it blustery. And Spanish banks, we'll watch all of those. We'll also watch gilt markets as they open up after yesterday's vote. This is Bloomberg.
Wednesday morning, we might tick a little higher this morning in terms of European equities. One of the reasons for that could be Europe went out when the US market was here. We rallied a little bit after that. There was quite interesting data yesterday, maybe suggesting the US economy actually isn't in that bad shape. We did also hear Powell talking about the idea that maybe actually July could be on the table, but it might not be. The market certainly took some chips off the table when it comes to July. So net, I'm not sure there's much of a takeaway really for Europe today out of this chart. There's an interesting rotation, which Val's been talking about as well, out of tech and into some of the small caps. But it was the first day of the month as well, so you've got to bear that in mind, Critty.
Absolutely. Some green on the screen when it comes to the futures picture. Maybe a little bit of a catch-up trade to the U.S. that you just pointed out there. We are seeing Euro Stoxx 50 futures higher by about 0.4%. The FTSE 100 on the back foot. But what I think is really interesting is what's happening in this French market here. It is the outer performer this morning, Anna, in terms of these market futures, higher by 0.5%. That simply might be a rebound from the fact that yesterday the French index was the underperformer.
Yeah, absolutely. So we'll watch that. So European futures pointing higher then, Critty. Let's have a look at some individual names and some sectors that could be on the move this morning. And we start with renewables, the wind and solar businesses that have been so blown around by everything to do with the US budget. Well, once again, they could be in focus. And they could go higher as a result of one particular tax being removed from at least the latest version of the budget. Of course, it goes to the House still, so we're still not deal done there. Santander in focus. They have agreed to purchase the TSB business from rival Spanish bank Sabadell. So we'll see if that sticks to the sides when it comes to the start of trading for the Spanish banking business. And Airbus in focus. According to people familiar with the matter, delivering about 60 planes in June. That takes them to slightly more than 300 in the first 6 months. That's well short of halfway to 820, which is their target for the full year, Guy.
Yep, it's always challenging targets, and it always gets pushed towards the end of the year, and that's when the catch-up happens. Let's talk about today's trade, talking of catch-ups, and show you what is happening here in Europe. We are anticipating a positive start to the day. Not that positive, a little tick higher. Certainly that's what we're getting early on from the FTSE 100. It's a bunch of single stocks that are probably quite interesting today, maybe more interesting than the index-level story. But the Stock 600 also up by 0.2%. I think that's going to be the broader picture. You may get a little bit more maybe out of the CAC 40 this morning, so we'll wait and watch and see exactly what that market delivers this morning. But remember, there are significant catalysts emerging. Got payrolls that you've got to think about tomorrow. That's going to be the big story. NFP is out of the States. Plus, we've also got the trade narrative emerging as well. We don't know what's going to happen with the big, beautiful bill. There's lots of things that are kind of out there right now for the market to think about. So steady as she goes, maybe is the narrative. Little creep higher, but steady as she goes. What's the sector story, Critic?
Well, right off the bat, you are seeing a little bit of outperformance in some of the banking sector. And I think that's interesting because there are key ones in Spain that we've got our eye on. Broadly, green on the screen, Anna, across the board. But it's the banking sector that, of course, is really key, catching my eye. I'm going to try to get these words right. I want to get to Spain in just a moment, but your biggest index contributor this morning is actually HSBC. I'm seeing BNP, I'm seeing Barclays and BBVA, and, of course, Santander all in there. So in addition to, of course, what's going on in the banking sector specifically, seems to be a little bit of a cyclical tilt this morning.
Right, and Sabadell, very specific to that deal, the sale of the TSB business to Santander. So Sabadell up by 2.3% or so this morning. So it does seem as if we are seeing it stick to that side of the trade. Santander up by 1.5%. So, in fact, both of those rising. To your point, Gritty, seems to be about something bigger than just Spanish banking. If both sides of that deal are on the rise today. And, in fact, very few banks in Europe are in negative territory. It's the best performing sector, along with energy, which is not doing too badly this morning. But most sectors in positive territory, Guy. In fact, nearly all of them. Only personal, consumer, discretionary, grocery stores. That is the only sector that's moving lower. M&S, one of the names in the mix there on the downside.
I'm distracted by the gilt market. We are seeing a little bit of a pickup in yields this morning, but it doesn't look extraordinary. In fact, it looks pretty much in line with what we're seeing across the whole of Europe. So UK 10-year now yielding 446, 447. We're up by 1.3. Italy's up in terms of yield moves more than that. France is up kind of pretty much in line with that. So this doesn't look like it's out of kilter with what we are seeing elsewhere in terms of the moves that we are getting, despite the fact that the UK now has a bigger hole in its budget.
$5 billion, it would seem. That's
could be more. Apparently, this actually may end up costing money.
Right, so the $5 billion from yesterday, we already had the backtracking on the other way they were trying to get fiscally in line, and that was around the winter fuel payments, of course. We've heard from the front bench this morning, UK welfare concession costs will be set out in the budget, according to Pat McFadden, who is a UK cabinet minister, of course, and speaking elsewhere this morning. It will have financial consequences, he acknowledges. But to your point, Guy, this does not seem to be what is driving gilt markets today, perhaps other global trends in the driving seat.
Well, let's talk about one of those global trends, which, of course, is the fact that we are barreling towards the July 9th trade deadline. Is that something that's priced into these markets? We spoke to Marina Zavalok, Chief European Equity Strategist at Morgan Stanley, about the range of outcomes for European equities off of those U.S. tariffs. Take a listen to what she had to say.
20% is not priced in. I mean, we have a scenario where, let's say on July 9th, we go back to 20%. Theoretically, that could cause more than 10% downside to the European equities index. But I think given that the market has gotten used to things coming into play and then being taken off, probably investors would not price that 10% downside fully. It would be more like a 3 to 5% downside risk.
Joining us now this morning, Eric Whitenis, EMEA Head of Investment Strategy over at JP Morgan Private Bank, joins us around the table. Good morning. Thank you for joining us.
Morning.
We just heard Marina over at Morgan Stanley talk about this idea that 10% is priced in, 20 is not. Is there a magic number for you that this equity market is looking at when it comes to tariffs from the States?
I think we would largely agree with that type of range assessment. An expectation that the ultimate landing zone for tariffs is in that low double-digit type of area is something that the market seems comfortable with, has its head around, and would ultimately be palatable and acceptable on a go-forward basis. If we got to that high double-digit type of zone, maybe that 20% handle, the market would take it more poorly. But we have a degree of optimism that some common ground can be found here, and markets and economies are showing a lot of dynamism and flexibility to make their way through this adjustment period.
But that talks about country tariffs or regional tariffs. Talk to us a little bit about sectoral tariffs. Is that something the market should be pricing in right now?
It seems as though it is. If we land at an ultimate across-the-board rate that is not disruptive enough for global trade, and then we have these different targeted sectors, exceptions on different key industries, that again seems to be in a place that the market is thinking about what this means on a go-forward basis. There's a degree of reflexivity to the way in which global trade is occurring right now. If you take a look at China, for example, there seems to be a degree of pivoting that's happening to different countries. Goods are still making their way around the world, and growth has proved to be pretty resilient as we look forward.
Are your customers comfortable being risk-on at the moment with this equity rally?
So I'm glad that you mentioned that word, because the title of our mid-year outlook was actually comfortably uncomfortable. We thought it was kind of clever. And I do think that it is requiring, or the market circumstances requiring, a recognition that this is a bit of an outside-the-box type of year so far here in 2025. But if you look through a lot of these geopolitical events, policy events, and so forth, the reality is that plain old-fashioned earnings and economic growth have been continuing to come through. Yep. And at the end of the day, earnings is what it's all about, and we remain constructive.
Is there a different view from your US customers versus your international customers? Do they share the same views at the moment? You look at, there's a big move in the dollar. There's talk of the fact that international investors aren't putting money to work in the United States. Is there a difference in the way that they are approaching how they are investing at the moment?
I'd say the biggest difference is probably the degree of sensitivity to FX or lack thereof. Right. So what I mean by that is our clients in the U.S., they do tend to be a little bit more U.S. dollar and U.S. asset-centric overall. Here in the region, there's a bit of a debate going on in terms of how much do I want to be allocated, or how much the clients want to be allocated to the U.S. relative to ROW, rest of world. And I think there's two main ways to think about this. Way A would be the viewpoint that you sell the U.S. to invest internationally. View B would be you stick with your well-performing U.S. assets, which we think there are a lot of good reasons they will continue to perform well, and you add incremental international exposure. What you accomplish there is a greater degree of international diversification, and then you also lower your percentage concentration in the U.S. We think that's the right approach. Version B, add international.
So adding international, but sticking with some of the things in the US that you like. So that takes us into the second half of the year, because we saw it was the first trading day of the second half yesterday, and we saw some interesting things. People taking profits on the things that had done well in the first half. Is that going to be a theme we continue to see? I mean, for example, small caps were doing well yesterday. It was only one session, and we had some interesting JOLTS data that moved the market. But what are your expectations for the rest of the year? Does it look like the first half, Eric, or does it look really different?
I am skeptical it can be quite as eventful as the first half of the year, but I suppose time will tell. You mentioned JOLTS. I think that the next three labor market reports in the U.S. in particular are going to really matter. Now, the U.S. labor market report, of course, always matters, but in the next quarter or so is going to be more so in this tariff digestion period. So I think it will have an even more keen eye by market participants and the Fed as well. In terms of investments and sectors, we continue to lean into and favor financials, tech, and utilities in the U.S. One of my favorite stats about the AI theme at the moment is this incredible increase in the rate of adoption of AI. It was essentially 4.5% of U.S. firms are utilizing AI only 6 months ago. That has gone up to about 9%. So that's a 2x in just 6 months. And furthermore, the rate is increasing in its degree of increasing as we go forward. The curve is kind of bending, so to speak, and inflecting higher. And we think that's powerful for the tech sector.
OK, so still AI enthusiasm in the United States. Defence enthusiasm here in Europe? I mean, that's been a big talking point in the first half of the year. I'm interested how clients are thinking about exposure to defence at this point.
We like it. We have been aboard that theme and continue to have that viewpoint. It is very noteworthy and impressively decisive, I would suggest, this increase in NATO commitments in the region. And we really like seeing that sense of urgency out of European leaders, either on defense, elements of the Draghi report-oriented recommendations, infrastructure, investing for future growth. There is a greater degree of tangible optimism here in the region, and we think there's good and valid reasons for that.
Let me talk about one of the major bull cases for Europe, which is that this market has seen a lot of buybacks, a lot of shareholder returns, specifically from the financial sector, as you point out. When does that come to an end? If you start to see this idea of tariffs weighing or recessionary impacts or whatever these fiscal deficits and fiscal issues might bring about, a pullback in some of those shareholder returns, what's the canary in the coal mine for that?
So the buyback theme is certainly helpful, and we have more color on that in the U.S. or more information on that just in the last 24 hours. It's a theme we think is likely to persist both in the U.S. and elsewhere, and of course it's the old-fashioned supply-demand type of support structure, and we think that that will continue to be a factor for markets as we look ahead. From a debt standpoint, it is a little bit remarkable and impressive how resilient and comfortable global markets have shown with these ever-expanding levels of government debt. UK gilt yields are down notably from where they were just a couple of months ago. The U.S. 10-year yield is also down notably, closer to 4.2, 4.25%. It was about 4.6% amidst all of that uncertainty earlier in the year. So if we get enough growth, it's remarkable how much growth can paper over or cover up a lot of these debt concerns, and that's largely the theme that we're seeing, comfort in the bond market.
Eric, great to see you. Thanks for stopping by to see us. Eric Whitesiness, EMEA, Head of Investment Strategy at JP Morgan Private Bank. Let's take a look at those equity markets right now and see what is happening. We'll start with the call, then we'll get what Joe's eye is on this morning. This is the picture, as you can see, broadly bid. Ferrari a little soft this morning. LVMH is quite strong. And in fact, the CAC's having a slightly better day broadly with luxury back on the front foot. What else are we watching? Joe Easton's here with the details.
So one stock I'm watching very closely, Guy, is Greggs. Take a look at this one. We're down almost 14% at the open of trading for the UK bakery company. Now, they are saying in a statement that they have been hit by warmer weather, which kind of makes sense. You kind of don't really want a sausage roll and a hot chocolate in this kind of heat that we've had over the past couple of days and weeks. But that is the reason why they're lowering their guidance in an unscheduled statement to the market this morning. Analysts becoming very bearish, seen Shore Capital downgrading the stock and others reducing their estimates for the company. So Greggs, one of these really high-flying UK stocks hit by the warmer weather, potentially actually just some easing in the general consumer sentiment as well, weighing on that one, about a big mover in the UK today. Then in terms of other big UK movers, we've got Bytes Technology down 25%. Now, this is kind of a cloud and cyber security firm in the UK, more in the smaller cap space. But the statement from them also weighing on a Softcat as well, a bigger stock on the Stock 600 and the broader UK tech space. Taking a bite out of that one. The producer put me up to putting in that pun there, so I had to throw it in. But Bytes Technology down pretty sharply today, 25%, a big loss on that one. Then moving over to the ones that I kind of had a little bit more time to prepare for. The renewables gaining today, including Vestas, after this update from the Senate bill in the US on the big, beautiful bill, stripping out this provision that was going to actually tax projects that were using Chinese components in the renewable space. So Vestas gaining 9%, one of the best performers on the Stock 600 today. Ørsted gaining as well, Nordex and also EDP, all of the renewable stocks moving higher as expected, given that update on the big, beautiful bill. Then in terms of Spanish banks, we've got that deal coming through. Santander buying TSB from Sabadell. Unexpected kind of in terms of both the price and the actual bidder for that, but taken relatively positively at the open. Sabadell coming up 3% at the moment. Santander edging very slightly higher as well. Now, the new enlarged company Santander going to be serving more than 25 million people here in the UK. Then a couple of M&A stories to bring you. Firstly, Avanza over in the Nordic market. Now, this is kind of an investment services firm. There is a report in local media about potentially a takeover, a take-private deal for the firm. This is kind of a version of Hargreaves Lansdown in the UK, but over in Sweden. So that one up sharply. And then finally, we've got a price on the Spectrus takeover by KKR. It's at £4 a share. This one has been going on for some time, so we're seeing the stock actually coming up very slightly, even above that at the moment. This is the UK industrial component firm. Spectrus gets its takeover and rises almost 5% in London this morning.
Joe, thank you very much. Joe Easton from our equities team. Thank you for the update. So quite a lot of movers this morning, including in the Spanish banking sector. Coming up, Santander agrees to buy the UK bank TSB from Spanish rivals Sabadell. We will delve into the details of the £2.7 billion deal. That conversation next. This is Bloomberg.
The UK is really important because it helps stabilize our cost of capital, a risk-return profile. We have a low-risk business in the UK, is stable returns in a strong currency. So this helps stabilize the volatility of our returns that come in developing economies.
Santander CFO Jose Garcia-Cantera speaking with the show earlier about that deal for TSB. Let's get a little bit more insight on the merits, or maybe not so much merits for it, whatever the opposite of merits is. Bloomberg Managing Editor for Finance and Investing, Tom Metcalf, joining us around the table. Tom, this deal has left all of us, I think, scratching our heads a little bit. This feels like a very expensive deal for very little. What is Santander getting out of this?
Yeah, Santander are certainly paying up. They're paying, way over book value for it, which is quite unusual among UK banking. I think basically what really they're getting a very big mortgage book, which in their view very low risk. And also, they're looking at it from the group point of view. They have this very strong sort of tech system running through their system that they think will mean they'll be able to integrate TSB quite easily, and then also gives them scale in the UK market. So for me, the biggest thing here is this is Santander coming out, despite rumours they might even have been looking at selling their own UK operations. Now, going all in on the UK, and they're now one of the sort of top lenders.
And they clearly see the UK mortgage market, which is what they do a lot of, and will continue to do, as pretty low risk, because they say that this helps their risk profile. It sits alongside what they're doing in emerging markets and helps to balance the risk profile for the business.
Yeah, exactly. And, so they'll go from about 10% of the UK mortgage market to about 12. I think that makes them maybe the fourth largest now. So, yeah, it's definitely a business they're looking to get further into. And as you say, it's one of those that they think, there won't be too many painful provisions or anything like that coming down the line. It's just reliable earnings that sort of evens out that, as you say, in other markets, they're much more volatile.
If you're a shareholder, though, in Santander, is that what you want? Do you want boring? Because that sounds like what we're talking about here. Is that good news for your view of where this business is going? Could this money have been used elsewhere? Could this money have been returned to shareholders? Why are they paying over the odds for this business? There's so many questions around this deal, this transaction. It's so surprising that Santander have made a decision to invest in a market that until recently people were questioning whether they were going to continue to be in, not putting money to work in higher returning areas of the business, and not returning money to shareholders. Do you think shareholders are going to be surprised by this news?
Yeah, well, certainly some analysts are saying, this sort of looks quite interesting and surprising. But, look, shares are up slightly. I think boring is certainly good, for any company, but particularly for banks where, you just don't want those surprise shocks, say, from like the investment banking side or the capital market side. And yeah, I think basically what it does do is clarify the strategy. So where there might have been some confusion about, won't they sell the UK? Now it's very clear they're not. It's clearly one of their tent poles. And, perhaps with that focus, they can kind of, get the returns they're saying they will. And the idea of, scale in banking. If you're going to be in the UK, get bigger, because what you don't want to be is sort of on the smaller side here.
Well, Tom, there's a lot of speculation, not just from the media, but from the analyst community as well, that ultimately this is something that endangers the BBVA takeover for Sabadell. And my question to you here, and we kind of posed this question to the Santander CFO as well, is that where are we on that consolidation timeline? Is a deal like this making it harder for consolidation, not just in Spain, but in Europe, across the board?
So this is the other fascinating part of this thing, is this whole other thing going on, BBVA trying to buy Sabadell, which has just sold TSB, while it's under offer. So Sabadell have this duty of passivity. So what that really means fundamentally for the TSB deal, they have to go to their own shareholders and make sure they get approved. But they're doing a very good job of pushing this sale. They're saying we're going to do a big, extraordinary dividend, about 2.6 billion will go back to shareholders. So for me, that's the most interesting thing. Can BBVA, as a bidder for Sabadell, actually do anything to disrupt this? Do they want to? I mean, the question is, what would BBVA do if they owned Sabadell? They'd probably want to sell TSB anyway. But obviously, when you're the bidder, you kind of want that control. So that's something we're looking into, is where does this leave BBVA? Can they do anything to intervene? Do they just have to watch? And what does that mean then for a deal where they originally bid, obviously, for Sabadell with TSB?
Yes, and Sabadell saying that the two have nothing to do with each other. They didn't do this because of the BBVA approach. We will look forward to your further reporting on that. Bloomberg's Tom Metcalf, then, with the latest on the banking sector.
Still plenty of questions to be answered. Let's turn our attention to what is happening in the auto space. Elon Musk has assumed oversight of Tesla's sales in Europe and the United States following the departure of one of his long-time deputies. This as the EV maker's vehicle deliveries are expected to climb for the second consecutive quarter, with sales figures due later today. Let's bring in Bloomberg's global auto editor, Craig Trudell. Is this a good idea? Musk, one of the reasons why sales are down is because of Tesla's association with Musk.
Yeah.
So is he being forced to do this, and is it going to have a positive impact?
It's probably, I may quote Taylor Swift too much, but it's
you can never quote Taylor Swift too much.
I'm the problem, it's me. I think that sort of may apply here, right, where Musk very much is, if not the biggest culprit for Tesla's weakness in Europe, is up there on the list, right? There was a lot of, questioning early this year about, just how much is it him versus the fact that they were changing over the Model Y. That is their most important vehicle.
Yep.
That was disrupting production across the world for the country. And so we did need to see sort of sales, play out for a few months to see, with that in the fold, will this company recover? What we've seen here in Europe the last few months is it has not. No. And so Musk has, of course, taken extremely polarizing stances on anything and everything on a day-to-day basis, and that includes here in Europe.
He recently pushed back at that suggestion, though, didn't he? And, we flagged the damage that his political stance seems to do to his sales in Europe, but then he says, but I do better on the right. So, is there any validity to that? What does the overall picture tell us, Craig?
I guess we have to some degree, we have to take him at his word for that. I think, in the U.S. Market, I think, of course, one of the things that he may have an issue with now is he's alienating Trump fans, right, by sort of going after the president in such an emphatic way. That being said, it may be the case that people are willing to overlook that and also may agree with him that it's not such a good idea to add trillions of dollars to the national debt. But in Europe, I think it is absolutely the case that, he is still viewed as sort of, part of this Trump movement. Trump, of course, is not particularly popular in a lot of major countries in Europe that happen to buy a lot of electric vehicles. And I think it's also just been the case, too, that we've seen this region get a heck of a lot more competitive in the electric vehicle space because of the Chinese competition, and despite tariffs.
And, of course, he commented specifically on European politics as well,
right.
So maybe not necessarily to do with his stance in U.S. politics, but the things he said here in Europe. Kriti.
Absolutely. Craig, very quickly, a question here on supply chains. One of the big questions of Tesla during COVID was simply that you build your factories in Berlin or Shanghai closer to the supply chains. Do you think that strategy changes as we're talking about sales declining?
I think there is a real question for me of Tesla has built this massive plant in Germany, had plans to expand it. Do they step back from those plans given the weakness in this market? Do we start to see actually some taking off of shifts, more downtime in that factory? Because right now we just are not seeing the degree of sales there, and that does raise real questions about how much suppliers are really concerned. Because when the company does set up new factories, as is the case with the rest of the industry, they want to localize their supply chain and tap suppliers that are close to that new plant.
Certainly something we're going to keep a very close eye on. Where in Europe can you do that? Craig Trudell, Bloomberg's Global Autos editor, walking us through the Tesla story and how it interacts with Europe. Coming up on the program, we head to the ECB forum in Sintra, where Bank of Portugal Governor Mario Centeno joins our very own Francine Lacqua. That conversation next. This is Bloomberg.
The U.S. federal, fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
It's, of course, the Fed chair, Jay Powell, speaking to Bloomberg's Francine Lacqua in Portugal at the ECB forum. That was yesterday. Today, she's got another great guest. She's joined by him now. Francine, over to you.
Guy, thank you so much. Thank you so much. And good morning from Sintra, Portugal, where we had a good conversation on inflation, tariffs, and and actually what comes next. I'm delighted now to be joined by Mário Centeno, Governor of the Bank of Portugal, o Banco de Portugal. Thank you, Governor, for joining us. Look, there's a lot to talk about. It's inflation. It's actually when you see, is there a need for a cut again this year from the ECB?
Well, it's still in the middle of the year, so we have plenty of data to get. We remain cautious and following all possible numbers and evaluation that we have from what's going on. We just got 2% inflation in June. That's precisely on target, so this is very good news for us. The economy in the first quarter also showed strengths in Europe. We need to see if it keeps that profile over the course of the year. That will be great news for us. I'm worried, if I may say it like that, with investment, because we need a pickup in investment in Europe to sustain precisely these growth rates that we want to achieve.
So, Governor, are you worried that you're not getting enough investment? Do you have the numbers that make you worry, or is this a worry in absolute because of the tariffs?
I mean, it's the profile for investment in the euro area is, of course, impacted by the cycle of monetary policy rates. So it's actually the variable that responds more forceful to an hike in interest rates. So it's understandable in that sense, but it's taking too long for it to recover. So of course, uncertainty doesn't help either. So, and we have been plagued with sources of uncertainty that also deter investment. So we need to move away from these, give certainty to investors. Trade deals will be great, but that's to the European Commission to discuss. And if something on that vein occurs, I think we will make it.
Governor, I mean, inflation is also very much impacted by currency. We spoke to Vice President de Guindos yesterday. He was saying, look, 120 for euro is problematic. Do you agree?
Well, I think it's we need to think about the exchange rate as a market outcome, and markets adjust if there is some development that it's not sustainable. I'm sure that will show up in the numbers. We need to think about the current number, the current perspectives for exchange rate as reflecting the strength of the euro, what's going on globally. We are also pushing a lot to increase the international role of the euro. That, of course, will bring more investors to Europe, will increase the interest in the euro. So that's good.
Governor, how do you think about interest rate cuts? Again, given where we think we are in the neutral rate, if you cut further, then it will become actually stimulative. I mean, should that be a concern given all of the uncertainties, the oil price, inflation, tariffs, and trade?
There's a range of estimates for the neutral. And neutral means that everything else is also in equilibrium, if I may say. This is kind of too technical, but it means that we are at our potential in terms of growth, that the labor market is also in equilibrium. We are not there yet in terms of growth. So for the system, for everything to be in equilibrium, then the neutral for interest rates would be an important concept. And we have an history in Europe of very low inflation.
Right.
And I did see the fundamentals for that to be changed as much as we can comfortably only sit at neutral. But this doesn't mean that we need to rush into that. We need to see data. We need to look at what are the developments. The second quarter figure for GDP will be very important because if it confirms the first quarter number, that is a story. If we go again to tumble a bit in terms of growth, that will raise concerns, in my view, about how sustainable will the 2% inflation be.
Governor, should we worry about the inflation numbers going down significantly?
That is precisely my point.
But you're worried about them going down more than going up?
Yes. That's actually also the profile for inflation in our forecast. Yeah. We will begin 26 with a low number. There are base effects on that, but it's also the recent history of Europe. It's not one of high inflation, high pressure on that. So we need to be cautious about it.
Governor, do you believe that actually the euro can play a much bigger role in this, challenged global dollar reserve currency like Christine Lagarde wants euro to play?
That's a long-term project that we actually start talking about it 5, 6, 7 years ago. It's natural to happen as the institutional environment of the euro strengthens, and it has been that the case for already 10 years, that Europe plays a more compatible role in the world with its history, with its reach to the global economy. So I think it really is important for us to work towards that goal, and we have been doing that. Mm-hmm. We have been strengthening the institutions in Europe. Also fiscally, we have been taking decisions that are really bold in terms of creating a union that is also fiscally more stronger and working together, so that's good.
Governor, when you look at the trade negotiations, right? I mean, it'll all come to a crunch in the next couple of days. Does it alter the path basically for the economy in Europe? And so ultimately, does it also decide whether the euro can become a global reserve currency?
It will have a big impact in reducing uncertainty. That's having a deal there. Gives clarity to consumers, to investors, to firms, to producers. So that's the main goal of it. It was nothing that we were asking for to happen, but once we have to engage on that, so the best thing is to settle a deal and tell people, look, this is what we have to work with.
Will that happen? Do you think we'll have some kind of deal, or does it get pushed back?
I think it's important to have a deal. I mean, I'm not involved in the negotiations, so I'm not going to comment on that, neither put pressure on those that are at the table, because those are not easy negotiations anyway. But it is really important to reach a deal and to send that message. Look, this is what we have with us, so let's work with it. If it's important for the continuation of this process of Europe gaining more relevance internationally, I'm sure it is. Europe is a very, very open economy. It's actually the openest economy in the great economies, in the largest economies in the world. So more than China, more than the US. We developed ourselves in this global economy, and we don't want it to go back.
But Governor, very quickly, I mean, does it impact, again, what we know so far of the tariffs? And I know there's a delay in actually, some of the concern, I guess, being filtered in the data. Is it bad for growth, inflation? Like, what are the second round effects?
It certainly is bad for growth because it's a tax. And we know what taxes do to economies. I mean, we will have a smaller economy after tariffs than we used to have. So that's almost clear for everyone on the table. And for prices, it depends on the degree of retaliation that Europe has. It can be deflationary for Europe.
Governor, very quickly, your term is coming to an end very shortly. Will you serve a second term?
That's a decision that someone else has to take. I mean, I'm comfortable in my position, so let's see.
Okay, but if they offer, you'd take it?
Yes.
Okay, thank you so much, Governor, for your time today. That was, of course, Mario Centeno, the Governor of the Bank of Portugal. With that, I'm going to send it back to you in London.
Bloomberg's Francine Lockwell there. We thank you so much. Of course, having a conversation with none other than Mario Centeno. We have more interviews from Sintra today, including a conversation with the Bank of England MPC member, Alan Taylor.
Gotta hope the wind dies down. Great windsurfing on the west coast of Portugal. Coming up, talking about maybe an ill wind. This time, the UK Prime Minister, Keir Starmer, abandoning his welfare reforms, leaving a potential £5 billion hole in the government's finances. We'll break down the implications next. This is Bloomberg.
The level of household and corporate debt in the UK economy is actually lower than we would have expected it to be, but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive probably than it would have been historically.
Bank of England Governor Andrew Bailey there, speaking at the ECB's forum on central banking in Sintra, Portugal, of course, accompanied by many other voices from the world of central banking. But it was really interesting what he had to say there about high interest rates not having the impact that they would previously have had in the UK because of lower debt levels amongst individuals and companies, crucially not governments.
So that's the problem the UK faces right now, is that individual companies don't have a lot of debt, so their buckets are relatively full. The government bucket is empty. How do you fill the government buckets?
Yeah,
tax rises,
potentially. Takes us on to our next topic, or what happened yesterday, specifically. Let's stay with the UK now, where Keir Starmer dramatically abandoned his flagship welfare reforms to avoid a major parliamentary defeat. The move leaves the UK Prime Minister's authority badly damaged and his government facing a widening fiscal hole.
Our plans will create a fairer society, one where people who can work get the help they need, where we protect those who cannot.
This is a rushed attempt to plug the Chancellor's fiscal hole. It is driven not by principle, but by panic.
Just a flavour of the drama in the House yesterday. Let us bring into the conversation Bloomberg's Ruth David and Bloomberg opinion columnist Rosa Prince. Very good to have you both around the desk with us to help us establish what happened yesterday, where we are nearly a year into the Starmer administration. I mean, I guess we get quite immune to hectic scenes in the House of Commons, don't we, Ruth? But this was a real climb down by the government. Keir Starmer had to really strip out the guts of this bill to allow some of it to pass.
Absolutely. And the Conservative Party, one of the spokespeople said, this government has lost its economic credibility, which is damning words coming from an opposition party that went through the Liz Truss regime. I mean, today the markets have been muted, so they haven't responded that dramatically. But the question is, if they have lost their economic and fiscal credibility, where do they get the money that's needed? They gave away $5 billion yesterday, right? And that's on top of what they had given away with the winter fuel cuts for pensioners that they rolled back on. But there is also a sense that if this government takes any decision that is fiscally prudent or that requires slightly tougher measures and there's opposition, they're going to backtrack. And, you know, what is that step between being a leader who listens to your party and being a leader who's seen as weak?
Yes, how you make difficult decisions, how you get the party to come along with you at a time when there are no easy choices, I suppose, is part of this.
Yeah, we're coming up on 1 year. I think the second year is going to be quite interesting. I think the challenges are going to get greater in the second year, not easier from the first year. So, Rosa, what do they do next? Are taxes going up? The question everybody's asking themselves this morning is, how high are taxes going to have to go? Which taxes? Are they going to have to pull some of the big levers, income tax, dare I say it, and some of the things they promised they wouldn't do?
Yeah, well, Pat McFadden, who's kind of the government's sort of attack dog, big defender of Keir Starmer, he had said this morning on the morning round that they would stick to their manifesto commitments on tax. Now, if you remember, there were these slightly weasel words where they said they wouldn't raise tax on working people, which has been taken to mean income tax, possibly VAT, national insurance. That doesn't leave them with very much. And I think what they seem to be doing is boxing themselves in again, which has been the problem of this whole year, where they say, we're not going to do that, we're not going to do that, and then in the end, exactly, what are you going to do?
I mean, it's interesting. The opposition party will say they've lost fiscal credibility. We remember the Liz Truss days, and of course others will. There'll be plenty of views about when or not fiscal credibility is lost. The government would still say they cling to their fiscal rules. At least we think they do, unless they change some of those when the next budget comes around. But the market, as you say, Ruth, is pretty calm. I mean, does that tell us anything about the market's judgment, or is the market just focused on other things? The market is thinking about the US budget, and the market is thinking about a strong euro, and it's thinking about a whole host of other things that aren't necessarily domestic.
I think there is definitely the latter. The market is focused on a lot of other things, and it has not been... I mean, this reversal hasn't had so much of an immediate Big Bang effect that the market should be taking into consideration, right? You're saying, well, OK, let's move it along to the budget in the fall and see what that brings. And maybe she'll find a way to increase borrowing, which I know she said she wouldn't do, but the tone of the government on that is changing.
Wouldn't do. So does this imply, and this is the question that everybody's now asking themselves as well, is she the right person for the job?
Absolutely.
In order to make the changes that are going to be necessary,
yes,
are we going to have to see a new Chancellor? And will Number 10 also maybe take greater control over the levers of power at the Treasury? Because the Treasury feels like it's pulled a lot of strings, a lot of levers over the last 12 months. Does Starmer need to get a grip on all of that? And is a new Chancellor required to get that grip?
I think that question on whose head rolls after all of this is definitely being asked, right? Liz Kendall was asked it on the BBC this morning whether her position was still tenable, and she said they made the right call by listening to dissenters. But while everybody was focused on the vote of welfare, there was another big bit of news that AstraZeneca might be looking at moving its listing to the US.
Yeah.
Now, that's important because in terms of UK national champions, it doesn't get bigger than that. And if they are saying we want to move our listing out, despite all that this government has been saying they'll do on the financial markets, that is a definite vote of no confidence, right? And the fact that they haven't said anything to that story yet is not a great sign. It just adds to the ticker of bad news for the government this week.
Well, Rosa, weigh in on that a little bit, because I feel like the UK hasn't fully recovered from the arm listing going to New York. How brutal would an AstraZeneca loss be?
Oh, absolutely. I mean, what a blow. They're trying to talk up the UK and saying it's a great place to invest, it's a great place to run a business. And then something like that just says more than 1,000 comments from ministers. I personally don't think that Keir Starmer can afford, actually, to sort of throw away Rachel Reeves' career, because I think he's so tightly bound up with her. I mean, particularly in the run-up to the election, they really came as a double act, and I think it would be a self-inflicted blow if he tried to blame this mess on her. I think the two big things she has done wrong were the initial decision to try to withdraw the winter fuel benefit, which just came out of the blue, kind of set the tone for the whole government, and then these cuts to disabled benefits, which again didn't really have much thought behind them. They were really just to save some money rather than to have a sort of whole body of work of welfare reform, which I think her Labour MPs thought was necessary. So Labour MPs are angry with Rachel Reeves. I don't think Keir Starmer will cut her loose. I just think that would rebound and look bad on her. I think maybe there will be figures inside Number 10 who will be worrying about their jobs, though, today.
OK, so there could be other heads that roll. Now, we are nearly a year in. You mentioned the winter fuel debacle, and it did seem as if something... I mean, this was £1 billion, more than £1 billion, but that's not enormous on a global stage at all, and yet it stayed in the news headlines in the UK for such a long time. So many things to learn on communication. As we approach 1 year of the Starmer administration, what else do they need to learn? Do they also need to learn that the Prime Minister maybe, sure, do well on the global stage, but also stay engaged at home?
Yeah, definitely. I mean, Keir Starmer's explanation at the weekend, he gave a series of interviews to mark his anniversary, was, oh, I was a bit distracted by what was going on the world stage. He had been at a NATO summit, he'd been at the G7. It's not really good enough. I mean, one of the things you have to be able to do as a Prime Minister is to be able to juggle. Multitasking is the name of the game. It's kind of why the role of Prime Minister was invented, why we don't just have individual departments running different sections of the state. We need somebody kind of bringing it all together. So I think that's something he's going to have to do. I think he's very brutally learned that he has to have better relations with his own MPs, because at the moment they're really running fiscal policy, which is not a good place to be in. There are some MPs who complain they've never met him, which is an extraordinary position. I know he's got a lot of MPs, but who have not met Keir Starmer. There are Labour MPs who have never met the Prime Minister. That's going to change. I think there will be some invitations into number 10. So that's another thing. And I think just generally, his communication is not very good as an operation. They don't seem to keep the public along with what they're thinking and doing.
That sounds like British understatement. Guys, we're going to leave it there. Thank you very much indeed. Bloomberg's London Bureau Chief, Ruth David, and Bloomberg opinion columnist, Rosa Prince. Let's talk about what we are seeing with the gilt market right now and just figure out whether or not it stands out from other markets around the world. And I think the answer this morning probably, as we've already alluded to, is it probably doesn't. We are seeing bond markets selling off, but the UK doesn't stand out particularly, Chrissy, in that regard.
No, it doesn't, but the currency kind of does. When you look at the pound here, for example, you are looking still at a 137 handle. I think the more exciting rally that we're seeing at the moment is in euro-dollar, and it kind of briefly hit that 118 handle, retraced. Now we're at a 117 handle. Bloomberg's Valerie Teitel is going to walk us through it. How excited should we be about this euro winning streak?
Well, it's the longest winning streak in 20 years for euro dollar. And, you know, yesterday it breached a new high for the year at 118.20. So there is a breakout currently happening in FX. It's pausing a bit this morning. But this dollar move is really rattling not just currencies in Europe. Also look at currencies in Asia, even the Taiwanese dollar breaching new levels this morning. And dollar Swiss as well. We got to talk about that one. That hit at a new low that it's not seen since 2015. We do have some Swiss CPI data tomorrow morning. There is a speculation if there's a big miss to the downside, if there's a deflationary print, I mean, you could see the S&B do an extraordinary cut in that kind of scenario.
2-year yields, are you thinking about the United States? I know you wanted to mention the short end of the curve. I was really interested that the JOLTS number seemed to capture the market's attention. I guess that goes to what Eric White-Ennis was telling us earlier. It's all about jobs data. Any cracks in the jobs data, and it's harder for Powell to wait and see.
Yeah, no, I thought it was an outsized reaction to the JOLTS data, especially when you have to remember the JOLTS data is 1 month delayed. That was data for May. The ADP today and NFP on Friday is going to be data for June. So, you know, I guess eyes looking forward. Obviously, Friday's print means a lot more in terms of where to next for the labor market. You know, you're getting a lot of questions on what kind of print would turn around this dollar weakness. And frankly, I don't think there is a print that would turn around dollar weakness. On a strong print, the market's just going to shrug it off, saying that, oh, labor market weakness hasn't hit yet. It's going to hit at the end of the summer. Powell's talked a lot about that, especially when it comes to the inflation impact from tariffs as well. On a weak print, you know, we're going to price in more of a Fed cut in July. Market's currently pricing in around 20%. If we get a weak enough print to move that substantially higher, I mean, that opens up another wave of dollar weakness as we continue to think about where, you know, where the Fed could cut to by the end of the year if the labor market deteriorates significantly.
The number's been creeping down all week. The whisper number's currently 100K, survey number's 110.
Anna Wong is 120, and she's the, you know, our Bloomberg economist. She always hits it on the nail. So she is going for a slightly hotter print than consensus.
Okay, there you go. It will be tomorrow, not Friday. Tomorrow we will be doing this. The holiday in the United States causing that. Anyway, that wraps things up for this show. The opening trade. The Pulse is up next. Anna will be taking you through that along with Francine Lacroix. This is Bloomberg.